Are you looking for some great stocks to buy over this holiday season? Well, you're in luck. Today's video, I'm going over 6 dividend stocks that will have great dividend safety scores, so you'll be able to rack in those dividends month over month. Each of these companies, except for the first one I'm covering, have dividend yields over 3%. And in fact, the last two have dividend yields above 6%. So you definitely want to watch all the way till the end so you don't miss out on those. Eddie V here sharing stocks to help you on your investing journey. If you're ready, let's jump in. First stock on our list is in the information technology sector. They have a market cap of $1.87 trillion, and that stock is Microsoft, ticker symbol MSFT. Now, Microsoft, as you may know, they have the Windows operating system in their Office suite, and they have the Surface laptop, tablets, and desktop. They also own SharePoint, LinkedIn, and Skype, and they have the Azure cloud storage, and you can't forget about the video games. They also own Xbox. So moving over here to Seeking Alpha, you can see from the year to date, they have fallen 26.78%. However, just this month, they have grown 9.5%, bringing us to a current share price of $245.12. So even though they have been growing this last month, looking over here at their 52-week range, they're still close to their 52-week low. And they are trading at a PE of 26.25. And generally, we're looking for a PE around 20 or lower. But in the case of Microsoft being close to its 52-week low and a growth dividend stock, it's a good time to start considering adding this to your portfolio. Dividend yield of 1.09%, so that'll give you an annual payout of $2.72. Wall Street analysts are considering this a strong buy right now with an average share price of $296, so that's about a 21% upside to the current share price. Looking at some chart analysis, you can see here the last couple weeks they've been riding pretty much around this 50-day and 25-day moving average. And they have been a nice trend moving up, and right now they're in the overbought region. They have hit their 100-day moving average, this green line right here, and they're starting to bounce back. So if we don't get a lot of volume like we have seen this past week, the last 2 days have been a lot of sells. So if we don't get that buying volume right now, most likely going to head down to our 50-day moving average. So just keep an eye on this trend right here to see if it starts to move over, and you can see the red line has crossed over to yellow and maybe looking at the downward trend moving forward. But it'll all depend on how much volume we get and if we're going to stick around this 100-day moving average, kind of like how we were above this 50-day moving average for a while. Over the income statement, looking at the revenue, you can see here that year over year they have been growing their revenue, which is a great sign. Scrolling down here to their profit, just like the revenue, they have been growing their profit year over year, which is great to see, as well as their earnings per share. They have been growing year over year as well. So great sign so far, Microsoft. As far as the shares outstanding, you can see here that they have been buying back shares the last couple of years, which is good to see. And as far as their dividend, they have been growing their dividend every single year, which is great to see for us dividend investors. One other thing to look at on their cash flow statement is to look at their free cash flow. This is important for paying dividends, buying back shares, paying down debt, making acquisitions, and also reinvest back in the company. So we want to see if the free cash flow is growing year over year. And you can see right here, they have been growing their free cash flow, which is great to see, in a 5-year average of $48 billion. Second stock on our list is also in the information technology sector. They have a market cap of $215 billion, and that stock is Broadcom, ticker symbol AVGO. Now, Broadcom is a combined entity of Broadcom and AVGO. AVGO focuses on the radio frequency filters that are in high-end smartphones, and Broadcom focuses on the semiconductor and broadband products that are in television set-top boxes, and also the connectivity chips that are found in Wi-Fi and Bluetooth. For the start of the year, Broadcom has fallen 20.73%, and looking at this last month, pretty much rose in 13%, bringing them to a current share price of $525.82. With a great rise over this last month, they are now close to their midpoint of their 52-week range, and they are selling for a PE of 14.15. They have a dividend yield of 3.09%, and they'll give you $16.40 annually. Wall Street analysts are also considering Broadcom as a strong buy right now, with a price target of $646, which is about a 23% upside from the current share price. So great to see for Broadcom. Right now, Broadcom is in the overbought region, and it is trading around this 200-day moving average, which is this white line right here. It did pass all the way through with this high buying volume right now, starting to tailor off here as we get close to earnings. So definitely want to keep an eye on Broadcom, especially as this red line is crossing over the yellow line and maybe entering into a downward trend. And over in earnings, anything could happen. So could jump up, could jump down. Moving over to the fundamentals for Broadcom, we have the revenue right here. And you can see Broadcom has been growing their revenue year over year. Scroll down here to the net income. Just like the revenue, they have been growing their profit year over year. They do have a spike up right here. And that was with an acquisition in 2018 with CT Technologies. So I'll give them a little boost when they acquired them. Scroll down here for the earnings per share. It has been growing year over year with that spike up when they had the acquisition right there. Otherwise, they have been growing year over year. And looking at their shares outstanding, coming into 2020, they started issuing shares, and now they are slowly buying back shares. As you can see right here, 406, and last year it was 413 million. As far as dividend, you can see that they've been growing their dividend year over year with a slight dip right now. As far as free cash flow, they've been growing their free cash flow nicely year over year as well. And they have an average of $11 billion. So great to see for Broadcom. Moving on, the next stock is in the industrial sector and has a market cap of $11.35 billion. This stock is Stanley Black & Decker, ticker symbol SWK. Now, Stanley Black & Decker manufactures hand and power tools, both for the average retailer and also professionals. And you probably see their products in any hardware store such as Home Depot and Lowe's. While the hand and power tools make up the majority of their revenue, they also have security services, which includes alarm monitoring and video surveillances. Now, this past year, Stanley Black & Decker has been hit hard. Over the past year, they have fallen 58%. However, this last month, they have grown a little bit, 4.17%, bringing them to a current share price of $77.73. They're still very close to their 52-week low, as you can see right here at $70, and they are trading at a PE of 17.96. Stanley Black & Decker has a nice dividend yield at 4.07%, which will give you a nice dividend of $3.20 annually. Now, Wall Street analysts are considering Stanley Black & Decker as a hold right now with an average share price of $86.23. So that's about 11% upside from the current share price. So there's some room to go there. Over here on the stock analysis, you can see here that Stanley Black & Decker the last couple weeks have been just trailing on their 25 and 50-day moving average right here. They did have a positive trend back in mid-November, but since then it's starting to trailer off. As you can see right here, starting to turn into that negative downtrend as we are seeing a lot of selling volume the last couple of days. If we do break through these moving averages, we will most likely fall back down to around $70, which is their 52-week low. So keep an eye on Stanley Black & Decker and might want to pick it up while it is at a discount. Over in the income statement for Stanley Black & Decker, looking at its revenue, you can see here, previously its revenue was bouncing between high 12 billion to 14 billion. And right now, the last 2 years has been hovering around that 17 billion. Part of the struggle that Stanley Black & Decker has had. Scrolling down here to net income. Previously, the last 5 years or so, they've been at the high millions, close to that $1 billion. In the last year, they were at 1.8 billion, and right now they've fallen a little bit at $1.4 billion. So a little bit dip right now in their profit. Going down here to their earnings per share, just like with their profit, their earnings per share did drop this year. Prior to that, it was basically hovering around that $4 to $5. We had a spike up last year, just like their profit, but tailoring back down a little bit now. So as the shares outstanding, they have been buying back shares, which is great to see. They did issue some around 2020, and now we're buying back shares. So great to see that there. And as far as their dividend, they have been growing their dividend year over year. Now looking at the free cash flow, prior to this year, they were growing their free cash flow steadily, so that was good to see. This year, they do have a negative free cash flow and pretty much affecting why their stock is falling. However, they do still have a 5-year average of $341 million, which will help them with paying those dividends and buying back shares that they are doing, which is good to know. Good to see right now with their stock so low, it is a good time for the company to start buying back shares. If you're finding value in this content so far, let me know by smashing the like button, helps grow the channel, and also spreads the video to other investors such as yourself. While you're down there, leave me a comment about your thoughts of any of the stocks I'm going over today. And also, I'd love to know what stocks you're keeping an eye on during this month. Next stock on the list is also in the industrial sector. They have a market cap of $158 billion, and this stock is United Parcel Service, ticker symbol UPS. Now, UPS is the world's largest parcel delivery service, and they have more than 500 planes and also 100K vehicles to distribute over 25 million packages per day to residentials and businesses worldwide. Now, over the last year, UPS has fallen about 18%, and over the last month it has grown about 5%, bringing them to a current share price of $175.10. So they are close to their 52-week low, which was $154, and they're currently trading at a PE of 14.04. They have a nice dividend yield of 3.38%, which will give you an annual payout of $6.08. Wall Street is considering this as a buy right now with a price target of $189, and that'll give you about 8.5% upside from the current share price. Right now, UPS is in the overbought section. You can see right now it is turning over. They pretty much hit their 200-day moving average, and right now is running right through their 100-day moving average, moving towards their 25-day moving average and 50-day moving average. So they have had a lot of selling volume the last couple days. However, in the last week, there was a good amount of buying volume, which basically pushed them through their 100-day moving average into their 200-day moving average. So definitely want to keep an eye on that. Before then, they were hovering around their $180 range, and they may be moving through their moving averages back to the $170 range. So definitely want to keep an eye on UPS right now. But with the share price coming down, it might be a great time to pick up UPS. On the income statement for UPS, looking at its revenue, you can see that year over year, they have been nicely growing that revenue, which is great to see. Going on here to its net income. Over its net income, just like its revenue, has been growing year over year with a slight drop in 2020, but pretty much picked up right afterwards and had a nice gain over the last 2 years. Scroll down here for its earnings per share. In 2019 and 2020, its earnings per share did drop a little bit, and they were able to bounce right back and made new highs for its earnings per share. Scroll down here once again, looking at its shares outstanding. You can see here that they're starting to buy back their shares, which is great to see. They issued some in 2020, which is understandable, and now buying back shares, which is awesome to see. And as far as their dividends, they have been growing their dividend year over year. Great to see as well. Now looking at their free cash flow, you can see that they have been growing year over year as well. So it's a nice spike up coming off of 2020, and they have a current 5-year average of $5.75 billion. So good for UPS. Next stock on the list is in the energy sector, and it has a market cap of $41.8 billion. This company is Dividend Energy, ticker symbol DVN. And Dividend Energy is an independent energy company that specializes in exploration, development, and production of oil, natural gas liquids, and natural gas. Over the last year, they produced over 1.6 billion barrels of oil equivalent, which made up about 74% of their overall production, and the last 26% was in natural gas. Since the beginning of the year, Dividend Energy has grown 43.5%. However, over the last month, they have fallen over 9%, bringing them to a current share price of $64.13. They're trading just above their midpoint of their 52-week range, and they're trading at a PE of 7.5. They have a dividend yield of 6.11%, which will give you an annual payout of $5.40. Wall Street analysts are considering Dividend Energy as a buy right now with a price target of $79.50, which is about 24% upside from the current share price. Now, Dividend Energy, looking right down here, it's in this oversold area, so you could consider it as a dog stock right now. Over the last few months, it has grown right through its 25-day, 50-day, and 100-day moving average, so it's hitting its 200-day moving average, which is this white line right here. And pretty much where it's at right now is around the support level, which is this $65 range right here. As you can see, it's pretty much bounced off of that $60 range a couple times in the last few months. So if it does break through this 200-day moving average, the next support level could be around $60 and even $55 range. Definitely when it's going in this downtrend, keep an eye on it. Probably a good time to pick it up at a discount. Over on the income statement for Dividend Energy, looking at its revenue, you can see here that last couple of years they've been bouncing around a little bit. In 2020, they pretty much had a drop, which is understandable, as you probably all know, but they were able to bounce right back up and made new highs. So you see 19 billion, which before it was around that 6 and 10 billion. So great to see for Dividend Energy. Scrolling on here to its net income, just like its revenue, was able to bounce back after having a negative $1 billion, was able to bounce back and had new highs. So right now 6 billion, which before was around that $1.5 and $2 billion range. So great to see. Scrolling on here for its earnings per share, it looks like it's growing its earnings per share very nicely. It was in the negative a couple years ago, 2020, and bounced right back and pretty much doubled what it had prior to 2020. Right down here, looking at shares outstanding, we could also see that they are buying back shares. They did issue a lot of shares coming out of 2020 and are now buying back shares. So great to see that they're buying back shares. And as far as this dividend, you can see here that they're growing their dividend very nicely with a nice spike up right there from coming off of 2020. So big improvement for their dividends to their shareholders. As far as the free cash flow, they didn't let us down. So just like their revenue and profit, they have a nice increase this last year and pretty much bouncing right back from what they had in 2020 and prior to 2020. And they have a 5-year average of $1.77 billion. So great to see for Devon Energy. Moving on to the next stock, which is also in the energy sector and has a market cap of $80.8 billion. And this stock is Enbridge, ticker symbol ENB. And Enbridge is an energy infrastructure company that transport different sectors across US and Canada. And these sectors range from liquid pipeline to gas transmission, gas distribution and storage, and also renewable energies such as wind, solar, and geothermal. Over the last year, Enbridge has grown a nice 0.41%, and over this last month it has dropped 0.7%, bringing them to a current share price of $39.39. So they are slightly below their mid-range of their 52-week range with a low of $35 and a high of $47. They're trading at a PE of 18.32. They have a nice dividend yield of 6.64%, giving you an annual dividend payout of $2.65. Wall Street analysts are considering this as a buy right now with the average share price of $39, which is about 1% upside from its current share price. So this stock isn't moving too much, pretty much been stagnant, but in turn it's giving you a nice dividend yield. If you'd like more of a deep dive into Enbridge, along with 3 other energy stocks, check out this video right over here, and I'll catch you over there. Remember, I'm not a financial advisor, so always do your own research before investing in any of the stocks I cover. Have a blessed day. Peace.